Hey, good morning, everyone. Sorry for the delay. And welcome to this Wednesday, October 18th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 25-30 minutes as we prepare for the trading day ahead. Yesterday, not a bad day. We're going to go over some of those numbers here in just a minute. Earnings season certainly starting to pick up. I was going to go over a few just quick numbers here this morning. Looking at the action before the open, Procter & Gamble beat this morning, $1.83 versus $1.71. ASML, that's a semiconductor stock, beat $5.23 versus $5. Abbott Labs beat $1.14 versus $1. Morgan Stanley beat $1.38 versus $1.27. Elevance Health, ELV, beat $8.99 versus $8.45. Those are all the companies reporting so far this morning with market caps of at least $100 billion. And early in earnings season, that's what we typically see. We see the big companies mostly reporting, and then we move on as we get through earnings season to the middle size and then smaller companies that generally have smaller accounting departments and need a little bit more time to come up with their numbers. I also want to mention after the bell today, Tesla reports earnings along with Netflix. So a couple of big names in the a couple of key aggressive areas of the market. So we've got Tesla, of course, in the consumer discretionary area, in the autos. Netflix, considered an online company in communication services. Both of those companies, I would say, are bellwethers in their respective areas. One, Tesla, doing a little bit better technically than the other, Netflix, which has been struggling, but still, that's coming up after the bell today. And it's just getting started. We got a lot of really big numbers, big reports coming out over the next 2 to 3 weeks. And we'll be here hopefully to guide you through it. I think, the chop that we've been experiencing may continue to linger for a little while. Yesterday, pretty good day, at least if you're looking at the Dow or the small caps, maybe not quite so good if you're looking at the NASDAQ. Today, futures red across the board with a little bit more weakness in small caps on a relative basis. So it's just been this constant, it's almost been like a tug of war where bulls, bears, both trying to get control. Bears initially had control, bulls trying to get it back. But at the end of the day, all we're seeing is a bunch of back and forth and chop. And we'll see whether or not that continues. Let's go ahead and get things going. I can tell you, though, crude oil prices up today, almost 2%, back above $88 a barrel. 10-year Treasury yield up another basis point, 4.86%. So we've got that as a backdrop to get things started today. All right, taking a look at what happened yesterday. Dow Jones Industrial Average finished up a whopping 13 points. We were kind of all over the place during the day. We had a pretty nice rally after morning weakness in most of the indices. Couldn't really hold on to it in some areas, though. The Dow did manage to squeak out a minor gain. S&P 500 down about 0.5 point. So down 0.01%. Not really a whole lot there. Still trying to navigate 4,400. Got up close to there intraday. Couldn't get through. You can see here on this chart that 50-day moving average is right there. Also, as we've been gaining ground, you can see the PPO has also been strengthening, but still below the zero line. So that needs to change on both the Dow and especially the S&P 500. You can see the AD lines on this move. AD lines actually starting to rebound. We did not see that on the initial move back in the second half of August. On that move on the S&P, which was very similar in terms of percentage gains, we saw very, very little movement back to the upside in the AD line. In fact, it wasn't until the very end of the move that we saw any movement back to the upside. This one's been a little bit different. Seems like there are some folks out there backing this move, and we are seeing that accumulation distribution line move higher. NASDAQ 100 down 0.33%. AD line also coming back here. Notice the highs, the last couple of highs here in September and then again in October. See how they're going down? Check out the AD line trying to move to a new high. So we're starting to see again a little bit of a character change if you look beneath the surface and not just at price action, but how the price action is developing throughout the day and how we're closing at the end of the day relative to how we open. Starting to show a little bit more signs of accumulation in the market, which I think is good for down the road, not necessarily for today or tomorrow, but we'll talk more about that in just a bit. Mid caps up 28 points yesterday, more than 1%, easily clearing the 50-day moving average, actually tacking on to where we had cleared previously. The IWM still struggling, though, to get through that 50-day moving average. That sits at 175.23. We were well above it intraday. I think we got up to 176 and change, but could not hold it. Came back down, closed at 174.95. And again, we see futures down again. So is this just going to be, failures leading to a further drop in small caps? I don't know. Next couple of weeks, we'll probably find out, because historically, this can be a little trying period in the market, especially next week. Transports gaining 128 points. That's up more than 0.8%. AD line not really showing a whole lot on this one, but price action trying to get back up to test that 50-day moving average, still just a little bit shy. Moving on to the sectors, energy leads, materials also leader. Look at what's been going on here. Major chop back and forth on energy. Really strong move up over the summer months, particularly late summer, June, July into August. And then we ran into some difficulties in September on the XLE. You can see that double top. You can see the drop beneath the low in between those two tops. Usually that's your measurement to the downside. So call it 93 down to about 89. That would measure to 85. Guess what? We went down to about 85, just a little bit below. Now here we come right back up again. Is this going to be somewhat of a kind of a weird looking cup? Is it going to be an inverse head and shoulder pattern? Here's your left side. This is your uptrend ending. Here's your left shoulder, left side of the neckline, back down to a lower low, which puts in the head. Now move back up to 92.5, could establish the right side of a neckline. A shallow right shoulder back down to about 88, 89 could be the end of that pattern, where then we break out above that 93 level and take off to the upside. That's one possible pattern. Of course, that kind of a strange cup, not really a rounded cup. You're not going to get a whole lot of liquid in this cup. So hopefully you're not too thirsty if you want to call this one a cup. I don't know. We'll see if any other patterns emerge here. But one major point from energy and materials is that these groups tend to be extremely volatile. And we're really seeing that here over the course of the past 3 weeks, 4 weeks, really end of September. We had a close to a 10% drop, probably 8-9% drop. And now we've gotten almost all of it back, all within a 3-week period. Pretty significant moves both directions there. Anyway, materials struggling, not quite as strong as materials on the chart, still needing to get through $80, which poses price resistance. Also, you can see the recent highs coming up above 79, but again, not able to get through 80, and the 50-day moving average sitting right at 80. Really almost no change in the AD line on the materials group, continuing to move lower. So I'm just not seeing a whole lot that excites me here on the materials group. Real estate continues to be very weak after a huge sell-off at the end of September. We have had a nice little bounce here, but now with the rates back up again, I wouldn't be surprised to see this group roll over. Yesterday, it was down about 0.5%. Now, I did something a little bit different here in terms of the industry groups. I was going to quiz you, but then I thought, well, I'll just give you the answer up front. But these are the top performing industry groups over the last month, 1, 2, and 3. This is the reinsurance group. Then you've got publishers and you've got defense. Of course, with the latest war in the Middle East, that's part of the problem there. That's why we're seeing a lot of rotation into defense stocks. As I look at the AD lines on these three, kind of three different stories being told. Number one, I look at the reinsurance and I look at the AD line and I say, well, something's going on here. I mean, not really bouncing, even though we've had a really strong move to the upside. But look at what's going on with volume. You have to remember volume is a multiplier, and volume, I haven't looked into this, so I'm not quite sure what has happened to the volume in the entire group, but you can see it's gone way, way down. So any moves to the upside, the volume is the multiplier. So we're not really, you can see it's going up, but it's not going up very much. And the reason it's not going up very much because the volume has been incredibly light relative to the rest of the year. So I don't know how much I would even trust the AD line on the reinsurance group until I find out a little bit more about what's going on with the volume. Because I think overall, as we were going up throughout most of 2023, you can see that the AD line, for the most part, was moving up until September. And then, of course, a lot of the market struggled as well. But that high right there did not come with a new high on the AD line. And then since then, it's just been light volume. So I don't know how much you can read into that. The publishers, on the other hand, haven't broken out on the AD line, but as volume has picked up, it has picked up with a very steady move to the upside, and the AD line is turning up very sharply. So this one looks much more bullish, not only in price action breaking out. I mean, how many areas are breaking out to new 2023 highs right now? Not a lot. So publishers breaking out the new highs, certainly they command one of those top positions in terms of relative performing industry groups. But that AD line is strengthening solidly as well. And so I think this one looks like a really good group heading into earnings. I would expect some nice earnings reports coming out of companies within this space, especially those that have the higher Scooter scores. Stock Charts Technical Rank. Scooter, SCTR, is an acronym for Stock Charts Technical Rank. So it's kind of a relative strength indicator. If you don't want to do your own relative strength, you could use the SCTR as a viable relative strength indicator. Then I see defense rising significantly, but even though we've gone back and taken out multi-month highs, look at the AD line, still way below. We have turned up, but we're still way below where we were back in July. So not really seeing the full support. What I'm seeing here, a lot of gaps and not really a lot of intraday buying. That's what this tells me. So defense, yeah, it's definitely doing well right now. Obviously, the war is kind of on the forefront, at the forefront of the news. And so I think that's helping the group gain. But again, a lot of it coming very quickly. It opens, not really seeing a lot of intraday buying, or not as much as you might expect. And so I don't know how much I trust this one down the road. Short term, yeah, it's fine. But further down the road, I don't know if we're going to have a sustainable advance here in the defense group. But hey, if the war escalates or something else breaks out somewhere around the world, sure, defense stocks can continue to move higher. It's really hard to invest when you're thinking that way, though. I mean, looking for a war to break out or to escalate in order to make money. But that's a group that does benefit from those types of atrocities. Let's keep moving. Let's move on to the 10-year Treasury yield. So first off, from an economic perspective today, we have the housing starts and building permits already out, and they came in, housing starts came in lower than expected. The expectation was almost 1.4 million units, and we came in at 1,358,000 units. So we came up probably about 2.5–3% shy of estimates, but building permits continued to rise, or beat estimates, I should say, because it is down from the prior month. But the estimate was for 1,450,000 units, and we came in with 1,473,000 units. That's a pretty good sign when permits are going up, because building permits are not required everywhere. So the fact that they're going up and we're not really including all areas tells me that the economy isn't as weak as the Fed probably wants it to be. And we're still seeing resiliency even in the housing and building construction markets. So listen, we've definitely taken a downturn. I'm not saying we haven't turned lower. My goodness, we've seen interest rates skyrocketing, mortgage rates especially. But it's not a dead group, based on the numbers I'm seeing. So if at some point we do see rates come back down again. Don't be surprised to see a lot of folks jump right back in to the home construction area. But anyway, here is your 10-year Treasury yield, still rising today, even with the housing starts coming in below expectations, still seeing another new potential closing high. And that's what we saw yesterday on the close. We jumped up to 4.85%. That was the highest close we've seen since probably back in 2006, 2007. Been a long, long time. So anyway, interest rates continuing to pressure the market. So listen, there's a lot of bad news out there. And if you follow the stock market, and if you followed it for years, there's always bad news out there. One of the sayings about the stock market is that Wall Street climbs that wall of worry. And that's what it does. 99 times out of 100, maybe not 99 times out of 100, maybe 80 or 90 times out of 100. The wall of worry is always there. There's always bad news. I mean, all my life I have heard just day in, day out, week in, week out, month in, month out, even year in, year out, sometimes decade in, decade out. We've had bad news. If you try to trade the market based on what you're hearing, you're going to hear mostly bad news. You'd never get in the stock market. You'd absolutely never get in. And I've been seeing recently, only because you can't help it, anywhere you go on the internet, unless you just don't go on the internet, anywhere you go, there's stories everywhere about the stock market crashing. And it's October, and October has been home to some of the biggest crashes. Think 1929, think 1987, even to some extent, the financial crisis. We saw October and November see some pretty big drops back in 2008. So October's got a bad name because of some of those outliers. Overall, October really isn't a horrible month, although next week historically is a bad week for the market. As I look at the market, first of all, I don't try to predict crashes. Think about in my lifetime, what I would consider a crash, whether it be in a very short period of time or whether it be, over an extended period of time, probably the mid 1970s, was it 1974 or so, when the market took a drop of about 50, 60%. I think it was around 50%. That certainly would qualify. That scares everybody quite a bit. You lose 50% of your holdings. I would say, of course, 1987 crash there. The Dow lost, was it 20, 25% in one day? Black Monday, October 19th. Tomorrow's October 19th, by the way. So we had 1987. We've had some flash crashes. There was one in 1998. Of course, the dot-com bubble. That was just a slow death, but from 2000 to 2003, late 2002 into early 2003, we saw many of those technology names, even the big names, lose 70, 80% or more over that period. So that was a crash, but it was like a slow crash. It just kept going throughout periods over a 2-3 year period. 2007, especially 2008 with the financial crisis, that was a really scary period for me as an investor. That was probably the scariest period, just because we have such reliance on our financial system, and it was on the brink of collapse. So that was certainly one. We could talk about the pandemic certainly being one, dropping 35% in a month, less than a month. That qualifies as a crash. But how many did I just name? 5, 6, maybe half dozen. And I'm going back as long as I can remember. And I followed the market a little bit back in the 70s. Wasn't invested back in the mid 70s, but I remember what was going on back then and all the fear. I remember it through my parents. I remember it through the gas lines and all the things that happened. My point is, we're always sitting back waiting for the crash that happens once a decade, maybe once every dozen years. Don't you think that's a little odd to just keep waiting and waiting and waiting for the crash? I'm going to show you a couple long-term charts here. Let's pull up the S&P 500, and I'm going to go back I mean, let's go back 75 years. And I want to stretch this chart out. So here it is. I mean, look at the left side of the chart to the right side of the chart. Again, how many times have crashes been predicted and then we actually followed through with a crash? I mean, here was that mid 1970s I talked about. There's 1974. Here's 1987. And that was a crash, but I mean, put it in perspective. Look how much we went up in the early mid 1980s before the crash. I mean, if you had just closed your eyes, if you invested in 83 and you woke up in 88, you'd have been pretty happy with that, even after the crash occurred. So that crash was very temporary, and we went right back up to new highs a year or two later, a couple of years later. 2000, again, looking at perspective, that big drop came after 20 years of, for the most part, just straight up action. The drop in 2007 to 2009 was the end of the secular bear market, where we went 12 years, did nothing. Back here, 12 years, did nothing. It happens. That's how the market works. We go from, in asset classes, we go from one leading asset class, next cycle, that asset class is lagging. Stocks go through periods where they outperform, they go through periods where they underperform. So if you look back into the 50s and 60s, outperforming. 70s into the early 80s, underperforming. 80s to the 90s, outperforming. At the end of the 90s through about 2012 or so, underperforming. And now we're in one of these periods where we're outperforming. Yes, we had a crash in 2020. I said at the time it would be a blip on the radar. Look back, it's a blip on the radar. We had a correction last year in 2022. Look, I mean, we're still in this nice uptrend. And rates, as bad as you feel about interest rates, just about every one of these periods going back 75 years would love to have the interest rates we have right now. Now, again, on a relative basis, yeah, it stinks. We were at zero. Everything was cheap. Money was cheap, easy to borrow, easy to buy a house, much more affordable because rates were so low. So yeah, it's higher. It's not as good anymore, but it's still not bad. And yet I hear people, oh, we're going to crash. We're going to crash. We're going to go back. I saw one this morning. S&P 500 is going to drop to 1,300. It's going to drop to 1,300. It's going to be way down here. So effectively, someone believes that the U.S. economy is no better off now than we were 23 years ago. Despite all the GDP growth we've had, despite the lower interest rates, somehow we should be valued below where we were at the beginning of the year 2000. Just for me, common sense, no chance. I mean, it's crazy to even talk like that. Now, could we go lower? Yeah, I mean, we could go down. I mean, if you connect these lows right here, I mean, maybe, worst case scenario. And believe me, I thought 4,300 was worst case scenario, and we got to 4,200 and change. So this isn't a perfect science. I could be wrong. Maybe we go back down and test that low that we saw in 2022. It's possible. I'm not investing based on that. I don't believe it's happening. I give it a very low probability, but it's possible. What do I think of the chances of us going to 1,300 or even the pandemic low at 2,100? I would say very close to zero. Certainly 1,300 is going to be 0.00001 for me. The pandemic low, I mean, that's when we were panicked. This low wasn't a well thought out low. It was oh my gosh, I'm just going to sell no matter what. And those panic lows are like generational type lows when you do that. So no, I don't think we're going back down to 2191. What do I give that? The odds of that? Probably 0.01%, 0.001%. I don't know. Pretty low number. Could we go back down to 3,500? For me, I'm going to still say, I don't know, maybe 2% chance, 4% chance. I don't know. I give it a very low chance, but possible. Instead, I think the more likely direction is that we're going to go up just like we've been going up since the 2009 low and since we broke out above the 2000 and 2007 highs. That in 2013 was where we started this secular bull market advance. And interest rates, even though they've gone up, interest rates, 10-year Treasury yield at 5% or below in that area is not going to stop a bull market, a long-term bull market. That's just my opinion. But I always like to look at these long-term charts for perspective. NDX, here's a monthly chart, but just looking at the last 15 years. I mean, this looks a little bit like a cup, although we didn't quite get all the way up to the top. I like to see a completed cup. But monthly, you know, when you're in a bull market, you tend to trade above the 20-month moving average, which tends to be above the 50-month moving average. That's been the case. The 20-month moving average has been above the above the 50-month moving average every single month since back in 2010. Secular bear markets don't have that. Secular bear markets take us down long enough where the 20 goes below the 50. Where are we now? We're trading above the 20 and the 20 is above the 50. Go ahead, predict a crash if you want. You got the odds of, let's see, there have been, what, 5 of them in the last 60 years? You know, I would say history is much more on your side to get in after you've had an 8% correction, which is about what we've had, especially on the S&P 500. More than that on small caps. IWM from 199 went back down to 169. That's 30. That's down 15%. History tells us that's the time to buy, not the time to sell. Anyway, here's your IWM. Long-term chart still in an uptrend. Big area of resistance was 160. We broke out above it. We've been holding 160. It's not performing as well as the NASDAQ or the S&P 500, but this is not a broken group long-term. Sure, you want to look back at the last 3 months and try to forecast the next 10 years based on the last 3 months, feel free. But if I'm looking at where I think the market's going to go long-term, I want to look at a long-term chart. And honestly, I see a chart that outside of a couple of panics there with the pandemic, here in 2008, 2009 financial crisis, we haven't really traded below the 50-month moving average. And right now we're sitting right on it. So I'll let you decide. Do I think there's an October crash coming? No. And it's pretty strong no for me. But there's bad news out there. And if you want to use that as what you believe is the catalyst for a crash, be my guest. It's up to you. Transports also long-term going up. I know recently not great. Look back over the last couple of years, not great. But again, you step back, you look at the long-term perspective, it gives you a completely different visual of where we stand in the stock market. All right, let's take a look at the chart of the day. For those of you that are interested, go over to earningsbeats.com. We actually have a chart of the day that is emailed out to free subscribers 3 times a week, Monday, Wednesday, and Friday. If you scroll down, all you need to sign up is your name and an email address. Subscribe, no credit card required. You can unsubscribe at any time. Very quick read, couple paragraphs in a chart. Today, I looked at the Reinsurance group. And I pointed out at the beginning of the show, this is the best group over the last month. And as we go into earnings season, I think it's important to see what groups are leading because it'll tell you what Wall Street believes about these companies. It's going to tell you that Wall Street is expecting really good numbers coming out of these companies. That's why these stocks are being bid up heading into earnings. So one of the things I'm going to do at our live trading room, which starts in about 30 minutes, is, and if you go back over here and you want to join, we do have a 30-day free trial. So come in, hit that join now button, and then you'll immediately be able to come into our live trading room in 30 minutes. But one of the things I'm going to talk about is I'm going to go through and show you how I go from looking at a strong industry group to finding really good trading candidates. And as I started to do some research, there's 1 or 2 of these that I may actually take positions in today. I want to see when their earnings reports come out but there are a couple of really good looking stocks in this group that we'll be talking about in about 30 minutes. So make sure you sign up for the 30-day free trial. That will require a credit card, but we will not charge you until we have sent you reminders at the end of the month that your free trial is expiring and that you're going to be charged. So we don't want you to be charged if you don't want to be a member, but if you haven't been a member or you haven't been a member lately, you might want to check out the service. It's pretty awesome service. I know I'm a little biased, but I have a lot of members telling me it's a great service as well. Anyway, that is it. So let's take a look real quick at what's going on this morning. You can see we are down again in the morning. That's been happening quite a bit of late. And then we rally back. We'll see whether or not today is any different. Personally, for me, I'm just expecting chop. Right now, until we get all of our major indices back above those key 20-day moving averages and continue to trend higher above across all of them. We're still lagging in terms of the small caps. But until we get that going, I think you got to be really careful. Also, again, historically, next week is the worst week of the year historically. This week coming up, and also the week we talked about back in September. Remember, from the 20th to the 26th? If you don't remember, we went down. So you got to be careful historically coming up. I would just be really careful. I'm not interested in any kind of leverage on the long side. If you're going to be on the long side, I definitely would be avoiding leverage. I would be avoiding margin, anything like that. And when I talk about leverage, I'm talking about leveraged ETFs primarily, but also margin. Just not the right time. I think as we get closer to the end of the month, I think then, especially if the market starts to begin strengthening, just be aware the October 27th close to January 18th close is the absolute best time to be in U.S. equities going all the way back to 1950. A lot of data supports being in starting the end of next week. Anyway, that's it for me. Come join me in about 30 minutes over in our live trading room at earningsbeats.com. Love to see you. Have a great day, everybody. Happy trading.